$36 billion.
Yeah.
It's a number that actually makes you stop and just stare at the screen for a second.
It is. I mean, we see big numbers all the time in tech or government spending.
Right.
But for a utility company.
Exactly. The folks who just send you a bill for running your refrigerator, for them to say they're dropping $36 billion over 5 years, you have to pay attention.
It is absolutely staggering. And honestly, it changes the way you have to look at this entire sector. For years, utilities were these sleepy, safe stocks.
The ones you bought for your grandmother, right?
Exactly. Stable, predictable, and, let's be honest, a little boring.
Now
They're dropping the equivalent of a small country's GDP to basically rebuild the entire machine while it's running at full speed. This isn't just keeping the lights on anymore.
it's an industrial arms race.
It really is.
That sets the stage perfectly. Welcome to the Deep Dive. It is February 18th, 2026, and we are looking at the Q4 2025 earnings report from FirstEnergy ticker FE.
The report dropped yesterday, and we just got off their earnings call this morning.
And if you're tempted to tune out because we said the words earnings report, please do not touch that dial.
Please don't, because this isn't really about a spreadsheet. This is a story about the physical reality of the AI boom.
Right.
We talk about the cloud like it's this magical, ethereal thing, but FirstEnergy is showing us the copper, the steel, and the billions of dollars it takes to keep that cloud online.
It feels like a collision of three massive forces. You've got a grid that is, well, arguably falling apart from old age.
Mm-hmm.
You have data centers that are hungrier for power than anything we've ever seen in history.
And then you have us.
And then you have the customer, you and me, who really, really does not want to pay more for electricity.
That is the trilemma, if you will. Management called 2025 a transformative year, and you know what? For once, that corporate buzzword might actually be true.
So our mission today is to unpack this $36 billion gamble. We need to figure out if they can actually pull this off.
And what it means for the grid at large.
But before we get to the future, we have to look at the present. I mean, you can't launch a rocket if your launch pad is crumbling. How did FirstEnergy actually do in 2025?
The short answer, surprisingly well. If you look at the scorecard from yesterday, the ship is very steady. They reported GAAP earnings of $1.77 per share.
Okay, up from $1.70.
Mm-hmm.
But we know Wall Street usually looks past GAAP at the core or operating earnings.
Right, and that story's even better. Operating earnings hit $2.55 per share. That actually beat their own guidance range.
And it's up almost 8% year over year.
Yeah, and in the utility world, 8% growth is like a tech stock seeing 50% growth. It's significant.
What about revenue?
That was the big surprise. They pulled in $3.8 billion for the quarter. The analysts were only expecting about $3.2.
So they beat by nearly $600 million. That's a massive beat.
Huge. And because of that financial health, they raised the dividend by 5%, and S&P, the rating agency, upgraded their credit rating to BBB flat.
Which sounds like a report card grade, but in finance, it's a huge deal. It means it's cheaper for them to borrow money.
Exactly. And borrowing money is the name of the game right now. That credit upgrade is basically their license to go out and announce this energize the future plan.
Let's get into that. The $36 billion figure. This is a 5-year capital investment plan. How does this compare to what they were doing before?
It's a step change. It's nearly a 30% increase from their previous 5-year plan. They aren't just tapping the gas pedal, they are standing on it.
And if you follow the money, it tells you exactly what they're afraid of. Break it down for us. Where does that kind of money even go?
So of that $36 billion, a full $19 billion is going specifically into transmission.
Transmission,
Yeah.
just so everyone's on the same page. We're talking the big, high-voltage metal towers that run across the countryside, not the wooden poles on your street.
Correct. Think of transmission as the interstate highway system for electricity. They're increasing spending on that interstate highway by 35%.
Why the obsession with transmission? Is it just to hook up new customers? Because $19 billion seems aggressive for that.
You would think it's for growth, but no. This is where the story gets a little scary about the state of the U.S. grid.
Yeah.
Management dropped a statistic on the call that, honestly, it stopped me in my tracks. They said approximately 70% of FirstEnergy's transmission lines.
Wait, hold on. 70%.
70%. And 30% of their substation assets are reaching end of life in the next decade.
Wow.
These things were built in the 60s and 70s. They were designed to last 40 or 50 years. Time's up.
So that $19 billion,
Yeah.
it's not for shiny new towers. It's emergency surgery.
A huge chunk of it is, yeah. They have to replace this stuff just to keep the system from failing. So this record-breaking spending isn't all for growth, it's just to stand still.
It's a reliability tax.
That's the reliability tax. But here's the nuance. In the utility world, even replacing old stuff counts as growth for shareholders. They're projecting a rate-based growth of 10% per year.
Rate base. Let's pause there because that term comes up constantly. How'd you explain that?
Okay, think of the rate base as the total value of the pile of stuff. The wires, poles, transformers that the company owns.
Right.
The regulators let them earn a guaranteed profit on the size of that pile. So the more they build or replace, the bigger the pile gets and the more profit they can technically earn.
So spending $36 billion is actually good for their shareholders,
Yeah.
assuming regulators approve it.
Precisely. It drives their target of 6% to 8% earnings growth through 2030, but they can't just build for the sake of building. They need a reason.
And that reason is the robots, or at least the servers that run the robots.
It's the AI hunger. This is the growth engine. FirstEnergy revealed they have a pipeline of 13 gigawatts of data center opportunities through 2035.
I want to contextualize 13 gigawatts. Rule of thumb is 1 gigawatt powers about 750,000 homes.
Yep.
So 13 gigawatts is like powering 10 million homes.
Essentially, yes. It's a staggering amount of energy just for computer chips. And it's not spread out, it's highly concentrated.
They mentioned specific locations on the call: Maryland, Pennsylvania, Ohio. Why there?
It's all about latency and fiber. They're close to major internet backbones. If you're training a massive AI model, you need to be close to the data pipe.
So Maryland is seeing the immediate activity, but they expect this huge ramp up between 2031 and 2035.
Right. And this connects directly back to that transmission spending. You can't just plug a 1 gigawatt data center into a wall outlet.
No, you'd melt the wall.
Exactly. Management did some interesting math for us. For every 1 new gigawatt of data center demand, it drives about $250 million in new capital for transmission.
That's the extension cord cost.
Right. The data center pays for the power, but FirstEnergy has to build the highway to get the power there.
Okay, so we have old wires needing replacement and new data centers screaming for power. But here's the problem I see. You can build all the wires you want, but if there's no generator at the other end making the electricity, the wires are useless. Where is the actual juice coming from?
This is where the call took a really fascinating turn. We have to talk about West Virginia. This is what I'm calling the West Virginia pivot.
Why a pivot?
Well, for the last 20 years, the trend has been deregulation. Utilities were told, sell your power plants. You just manage the wires. Let the free market build the plants.
Right. Become a wires-only company. Less risk, steady returns.
FirstEnergy is reversing that. They announced a plan to build a 1.2 gigawatt combined cycle gas plant in Maysville, West Virginia.
And combined cycle just means it's more efficient, right? Uses gas and steam.
Yes, it's standard modern tech. But the headline isn't the technology, it's the business model. They looked at having someone else build it and then buying it.
And they said no.
They said, no, we're going to build this ourselves. They're going back to the old school model. We build it, we own it, we run it.
And there seems to be a lot of political pressure here, too. I noticed they mentioned the governor.
Immense pressure. West Virginia Governor Morrissey has basically challenged the company. He has a state goal of 50 gigawatts by 2050, and he told them, you need to help us hit that number.
And the CEO didn't shy away from that.
Not at all. He literally said on the call, I accept that challenge. He said if this plan gets approved, they're looking to build more. It's a complete 180 from the old mindset.
But wait a minute. A plant like this costs, what was it, $2.5 billion. How do they pay for that without wrecking that shiny new credit rating?
They're getting creative. They applied for a loan from the U.S. Department of Energy. It's called the Energy Dominance Financing Program.
That sounds intense.
It is. They want to fund half the project with a low-interest government loan. They claim it could save customers $200 million over 30 years.
Okay, but there was another acronym they threw out that makes me nervous. CWIP.
Ah, yes. Construction work in progress. This is always controversial.
Right.
Usually you don't pay for a plan until it turns on. It has to be used and useful.
That makes sense. I don't pay for a sandwich until you hand it to me.
Right. But CWIP changes that. It lets the utility charge you a surcharge while they're building it.
So I'm paying for the plant in 2027, even though it won't turn on until 2031.
Exactly. The utility argues it lowers overall financing costs, which saves you money in the long run. But for you, the consumer, it means bills go up sooner.
Which brings us to the elephant in the room, the consumer. We've talked about billions in spending. How do they do this without customers rioting?
That is the tension of the next decade. Management has a very specific defense for this. They kept emphasizing that FirstEnergy only controls about 32% of the total electric bill.
Walk me through that. When I get a bill, I just see the total at the bottom.
Well, in states like Ohio or Pennsylvania, the bill is split. You have the cost of the actual energy, the generation charge, and then the delivery fee, the distribution charge.
So FirstEnergy is just the delivery driver. They control the delivery fee, not the price of the pepperoni.
Perfect analogy. They're saying, hey, we're only a third of your bill. And they point out their current bills are about 20% below their peers. So they feel they have some headroom.
But they made a pretty bold promise on the call. They claim that even with all this spending, they can keep bill increases at or below inflation. That sounds incredibly optimistic.
It is ambitious. To do that, they can't just raise rates. They have to cut their own costs. They mentioned they've achieved $200 million in operational savings since 2022.
And they threw in the AI buzzword again here.
They did. They're claiming they'll use AI to keep their operating expenses growing at only 1 or 1.5% per year. So using AI to fight the costs of the AI boom.
In a way, yes. And there's another factor helping them, right? Taxes. In Ohio.
Yes, this is a big deal. In 2027, a tax law change in Ohio kicks in that reduces their property tax assessments by $100 million. That's $100 million less they have to collect from you. It gives them a buffer.
And what about Pennsylvania?
In PA, they use something called a DSI, a Distribution System Improvement Charge.
We love our acronyms today.
Utilities run on them. Think of DSI as a fast pass. Instead of a huge, slow legal case to raise rates, they can add a small surcharge automatically as they spend the money.
So it reduces that regulatory lag.
Exactly. It's great for their cash flow, and they argue it avoids those sudden, massive rate spikes for customers.
Okay, so they have the plan, the money, the regulatory cover, but can they actually build it? We hear constantly about labor shortages.
That's the biggest execution risk. You can have the money, but if you don't have the linemen to climb the towers, it doesn't matter. Management claims supply chains are loosening up, but labor is still tight.
So they're betting on their size,
Mhm.
right? Being the customer of choice.
Right. If you're a contractor, you send your best crew to the company spending $36 billion. They're betting their checkbook is big enough to skip the line.
We can't wrap up without talking about PJM, the grid operator.
PJM is the air traffic controller. They don't own the wires, but they tell the electricity where to go. And you can't just build a new transmission line without their approval.
And that process is notoriously slow.
Glacial might be a better word. The stakeholder process at PJM is a constant point of friction.
Why is it so difficult? It seems like everyone agrees we need more power.
Everyone agrees we need power, but nobody agrees on who should pay for it. That's the core fight.
Right.
If FirstEnergy builds a huge line in Ohio that helps stabilize the grid for New Jersey, who pays? The Ohio grandma or the New Jersey factory?
That sounds like a nightmare to negotiate.
It is. That allocation fight slows everything down, so it's always a risk.
Let's zoom out and bring this all together. What is the big picture here?
The narrative arc is clear. FirstEnergy spent the last few years cleaning up their balance sheet and apologizing for scandals. That phase is over.
And now they're on offense.
They're on offense. They are betting the house that the world needs more power and that the AI boom is real and durable.
It really reinforces that the digital economy isn't just code, it's physical.
That's the takeaway. It's coal, gas, steel, copper, and billions of dollars in capital. If companies like FirstEnergy can't execute this plan, if they can't replace the 70% of wires that are dying, the AI boom hits a hard ceiling.
You can't train a model if the lights go out.
Exactly. And for the listener, this is a preview of the next decade. We're entering an era of high investment. And high investment almost always means higher bills.
So the era of cheap power might be ending.
Replaced by an era of necessary, expensive modernization.
I want to leave everyone with one final thought, something that's been bugging me since we talked about that West Virginia plant. We spent decades deregulating utilities, telling them to stop building power plants. And today, we talked about a major utility building a massive gas plant because the market couldn't move fast enough.
It raises a provocative question. Is deregulation compatible with the speed of the AI revolution? Or are we going to see a return to the age of the giant monopoly that does it all?
Simply because it's the only model that can build fast enough to keep up.
Right.
If FirstEnergy is doing it, others might follow. It's definitely something we'll be watching. Thanks for diving in with us.
Always a pleasure.